Welcome to On the Money, the video series where Wilkins Miller experts share updates, tools, and tips to help your business achieve more. My name is Jeffrey Kintz, and I'm a tax accountant with Wilkins Miller. I help businesses with all their tax compliance and planning needs so that they can focus on growing their business. With Halloween coming up, I would like to talk with you about something that can be very spooky if you're not prepared: phantom income. You may be asking yourself, well, what is phantom income? Well, phantom income is income that you have to pay taxes on despite not receiving the cash in the same time period. Two types of phantom income we frequently see are related to debt forgiveness and distributions in multi-owner or partner businesses. Let's get started with cancellation of debt income that arises after a debt has been forgiven. This is related to a legal loan that must be paid back at a future date, not the $20 that your friend forgot you owed him for pizza. One example is when someone lends money to your business through a legal loan. For whatever reason down the road, the lender then decides to no longer require repayment from your business. Generally, the forgiven loan amount is considered taxable income by the IRS. These taxes could cause great hardship on a business, especially if there are cash flow issues. The other common occurrence of phantom income is when the income that must be reported on your individual tax return is not consistent with the cash that you received during the year. If you receive a normal paycheck and a W-2, taxes are normally withheld throughout the year that you report on your individual tax return. If you're an owner in a business, you may not receive a normal paycheck. Instead, you may only receive available cash without any taxes withheld. You are still responsible for taxes on your share of income from the business, even though it may differ from the cash that you received. Also, due to the different tax laws, your taxable income may differ from the income reported on your financial statements. An example of this is prevalent in professional service organizations like doctor groups and law firms. If bill collections are delayed, a cash flow issue may arise. The owners or partners must continue to pay all operating expenses like payroll and utilities and may not pay themselves timely. Including a tax distributions clause in your operating agreement may help with this issue. This can allow for cash distributions of your projected tax liability from your business. In our profession, the most common answer to a question is, it depends. So please make sure to consult your tax professional and attorney before making any decisions. And that was On the Money.